We're all looking for that edge, right? That way to become uh, truly thoughtful investors without just getting overwhelmed by everything out there.
Definitely. It's easy to get lost.
So today we're offering a kind of shortcut. We're doing a deep exploration into Howard Marks' the most important thing. Think of it as, well, getting years of market wisdom distilled down.
Exactly. The crucial insights you need now. You want knowledge that, sticks, that's useful right away.
Yeah.
And that's the goal here.
Yeah.
We'll unpack the core of Mark's thinking. And honestly, there's some surprising perspectives, some really actionable strategies that might change how you see the market.
Or maybe even just how you make decisions generally.
Could be, yeah. So our mission today, really get to grips with the fundamental ideas in his book, ideas that apply pretty broadly.
Okay, so where do we start? He talks about the most important thing being multifaceted. What's maybe the first most important thing?
Well, he starts with something foundational. Second level thinking.
Standard level thinking.
Okay, right. Most people, they operate in the first level. Pretty straightforward stuff like this company's earnings are up, so the stock should go up. Simple cause and effect.
Okay, it seems logical enough. So what makes second level thinking different? It's about digging deeper.
Precisely. It's asking a whole bunch more questions. Okay, earnings are good, but is that news already priced in? What does everyone else think?
Ah, okay. The consensus.
Yeah, and how will their reactions move the price? What are the other possibilities? What could happen next year or the year after? It's thinking in probabilities, multiple steps ahead.
So it's less about the fact itself and more about the implications of the fact within the market context, seeing those hidden angles.
You got it. That's the aha moment. And Marx argues that developing this kind of thinking is absolutely key if you want to achieve, better than average results.
Makes sense. You can't beat the average by thinking like the average.
Exactly. Now, connected to that is another really crucial area, understanding risk.
Right. Risk. Most people probably think, volatility, stock prices jumping around.
Yeah, the standard definition. But Marx defines it differently, more fundamentally. For him, risk isn't just the ups and downs. It's the possibility of permanently losing your capital.
Oh, okay. That's a heavier definition.
It is. Or maybe more broadly, just the risk of not actually achieving your investment goals, whatever those might be.
And where does that risk come from?
Well, he lists a few sources, obviously that permanent loss we mentioned, but also things like using too much leverage, borrowing too much.
Amplifies everything.
Totally. Illiquidity, too, not being able to sell when you need to.
Yeah.
Putting all your eggs in one basket, basically over-concentration. And interestingly, overconfidence.
Overconfidence. How is that a risk factor? It seems like you'd want confidence.
You do, but overconfidence makes you underestimate the downsides, right? You take on more risk than you realize, maybe dismiss warning signs. Marx has this great quote, risk means more things can happen than will happen.
I like that. Acknowledges uncertainty.
Exactly. It's about remembering the future isn't predictable.
So if it's not just watching stock charts wiggle, how do we actually spot risk building up in the market? What are the signs?
Marx points to a few things. Big price swings, sure, but also watch credit spreads widening. That's the gap between safer and riskier bonds. General market volatility increasing. And maybe the biggest one, just market sentiment. Is everyone way too optimistic?
Complacency creeping in?
Right. He advises constantly asking, what could go wrong here? Really trying to imagine those negative scenarios.
It's like actively kicking the tires, looking for weaknesses, not just assuming everything's fine, more proactive.
Absolutely. Which brings us nicely to another pillar of his thinking, the relationship between price and value.
The classic value investing idea. It's not what you buy, it's what you pay.
That's the heart of it. Marx hammers this home. Success comes from buying things for less than they're truly worth their intrinsic value. And here's the kicker. It is price, not quality, that determines value.
Wait, say that again? Price, not quality.
Yeah. High-quality assets can be risky, and low-quality assets can actually be safe. It all depends on the price you pay.
Okay, that sounds backwards at first. A great company is always a great investment, right?
That if you pay too much. Think about it. Even the best company on earth, if its stock price is already sky high, reflecting years of perfect future growth, well, where's the upside for you? It might be incredibly risky at that price.
Any stumble means a big fall.
Exactly. And conversely, a company that looks a bit rough around the edges, maybe it's facing some temporary issues, could be a fantastic buy if the market has beaten the price down way too far.
So it's about finding that disconnect, where perception is worse than reality, and the price reflects the bad perception, not the underlying potential value.
Precisely. He talks about the Nifty 50 stocks back in the 70s. Everyone thought they were buy and hold forever stocks, the best of the best.
Right, the blue chips.
But people bid them up to insane prices. And investors who bought at the peak got crushed, even though the companies themselves were mostly fine. It drives home his point. It's not what you buy, it's what you pay. He talks about buying well versus just buying good things.
Buying well means getting the price right. Buying good things is just identifying quality, which isn't enough.
You need both, but the price is paramount for the investment outcome.
Okay, so we need to find these bargains, these things priced below value. But the market's always moving, things are always changing. How does that fit in?
That leads directly to market cycles. Marx is huge on this.
Yeah.
He sees markets swinging constantly between extremes. Greed and fear, euphoria and depression.
The emotional roller coaster?
Totally. Which leads to assets becoming wildly overpriced sometimes, drastically underpriced other times. He uses this great analogy of a market pendulum.
Okay.
It's always swinging, right? Rarely it just sits calmly in the middle at fair value. It swings from one extreme, say, excessive optimism, all the way over to the other, excessive pessimism.
And trying to perfectly time those swings is famously difficult.
Almost impossible.
Yeah.
But Marx says you don't need to time it perfectly. You just need to have a good sense of where the pendulum is in its arc. Are we closer to euphoria or despair?
Knowing the general neighborhood, maybe?
Kind of, yeah. Recognizing those extremes is crucial, and being ready to act as a contrarian when you see them. He has these two rules.
Let's hear them.
Rule number 1, most things will prove to be cyclical. Rule number 2, some of the greatest opportunities for gain and loss come when other people forget rule number 1.
Huh. I like that. People get caught up in the moment and forget things move in cycles.
It's human nature, which leads right into contrarianism.
Going against the herd.
But not just for the sake of it. Marx is very clear. It's about being different and correct. You need independent thought, you need courage, and crucially, you need a good reason to believe the crowd is actually wrong.
So it's not just reflexively doing the opposite, it's thoughtful disagreement.
Exactly. It's buying when fear is rampant and selling when greed is king. That takes real discipline.
No kidding. But the payoff can be huge, presumably.
That's the idea. As he says, large amounts of money aren't made by buying what everybody likes. They're made by buying what everybody underestimates.
Okay, so if we're trying to be contrarian and buy these underestimated assets, how do we find them? What do bargains actually look like?
Well, they often exist because of that irrationality we talked about, or maybe just people not fully understanding something. Marx suggests looking for assets that are maybe little known.
Off the beaten path.
Yeah. Or they look fundamentally questionable, at least on the surface. Maybe they're controversial, unpopular for some reason, unappreciated. Or they just have a terrible recent track record.
Stuff everyone else is avoiding.
Pretty much, he puts it bluntly. The necessary condition for the existence of bargains is that perception has to be considerably worse than reality.
You're looking for that gap again. Perception versus reality.
Always. But finding these things and waiting for the price to be right, well, that requires patience.
Ah, yes. Patience. Not always easy in investing.
Definitely not. Which brings us to patient opportunism. Marx really stresses waiting for the right pitch, waiting for those moments when the consensus is clearly wrong, fear is through the roof, and prices are genuinely low.
So resist the urge to always be doing something.
Absolutely. He warns that activity doesn't equal productivity. Overtrading can seriously hurt your returns. Sometimes the best thing to do is nothing. Just wait.
That probably resonates with listeners who feel like they don't have time to constantly monitor things, wait for the fat pitch.
Exactly. It's a more efficient use of your energy, focusing on high-conviction opportunities. And tied into this idea of patience and knowing when to act is, well, knowing your limits.
Knowing what you don't know.
Precisely. Humility. Marx emphasizes recognizing the boundaries of your own knowledge, and he's deeply skeptical about forecasting.
Predicting the future.
Yeah. He thinks forecasts are generally of very little value. The future is just too uncertain. So have reasonable expectations. You're not going to outperform constantly. You will make mistakes. Everyone does.
So focus on your process, not on trying to be a crystal ball gazer.
That's it entirely. Control what you can control, which includes understanding your own psychology and the market's psychology.
Right. The emotional side again. Fear and greed.
They're incredibly powerful. They drive those market extremes. Herd mentality, FOMO, the fear of missing out, these things create bubbles and crashes. Understanding these forces is a huge aha moment for grasping market behavior.
It's like seeing the hidden wiring behind the market movements. But even with a great process and understanding psychology, luck still plays a role, doesn't it?
Oh, absolutely. Marx is very open about that. Luck is a big factor, especially in the short term. Things can go your way or against you for reasons totally outside your control.
So how do you deal with that?
You focus on the process. He stresses that a sound investment process is way more important than any single short-term outcome. His advice: judge decisions by quality, not results.
Meaning a good decision that didn't work out immediately is still a good decision.
Yes, and a lucky outcome from a bad decision doesn't make the decision smart. Over time, a good process should lead to better results, even with luck involved.
Okay. What about common mistakes he warns against? You mentioned leverage.
Right, leverage is dangerous. But he also warns against the greater fool theory.
Remind me of that one.
It's buying something you know is overpriced, hoping you can sell it to someone even more foolish at an even higher price later on.
Pure speculation, basically.
Exactly. Unsustainable. He also points to ignoring valuation, just chasing momentum and, of course, blindly following the herd. These are classic pitfalls.
And the way to protect against these pitfalls and unforeseen problems is
Margin of safety. Another cornerstone. It means buying assets at a significant discount to what you think they're actually worth.
building in a buffer.
Precisely. It's your protection against being wrong in your analysis, or just bad luck. As Marx says, a low price is the ultimate source of margin for error. And that ties back to well bought is half sold. Get the purchase price right, with a cushion, and you've already done a lot of the work.
Makes sense. It's like insurance. Now, to consistently do this, you need a certain mindset, right?
Yes, the skeptical value investor mindset. You need to challenge assumptions, think independently, avoid the herd. But, and this is important, skepticism shouldn't become cynicism.
Meaning?
Don't be so skeptical that you dismiss everything. You still need to be open to new ideas, recognize when things genuinely change. It's a balance. Skepticism combined with curiosity.
Okay. And we touch on leverage, but maybe just reinforce that.
Yeah, it's worth repeating. Leverage magnifies everything, gains and losses. Marx sees it as a massive amplifier of risk. Use it very, very carefully, if at all.
Got it. So all these principles, second-level thinking, risk control, price value, cycles, contrarianism, margin of safety, they all seem to point back to one overriding concern for Marx.
They do. Preventing the permanent loss of capital. That's job number one. His whole philosophy is geared towards avoiding the big losers. He believes that if we avoid losers, the winners will take care of themselves.
It's a defensive strategy, in a way. Focus on not losing big.
It is, which leads him to clearly distinguish between investing and speculating.
What's the difference in his view?
Speculation is basically betting on price increases without a solid grounding in underlying value. It's hope. Investing, for Marx, is grounded in understanding intrinsic value and demanding that margin of safety.
And the foundation for that kind of investing.
Disciplined analysis, doing the homework, understanding the business, the value, the risks, no shortcuts.
And he also warns about times when the market itself becomes inherently riskier, doesn't he? Certain conditions.
Yes, he highlights periods characterized by too much optimism, too little risk aversion, and too much capital availability. When there's, as he puts it, too much money chasing too few deals.
Everyone's throwing money around, pushing prices up.
Exactly, which inflates asset prices and makes future returns much harder to come by. It's a danger sign.
Okay, one last concept before we broaden this out. Asymmetrical returns. Sounds fancy.
It just means getting more upside than downside. Achieving good gains when the market's up, but limiting your losses when the market's down.
Capturing more of the gains than the losses over time.
Right. It's often called alpha. Marx sees this ability, often stemming from a better grasp of probabilities, as a key sign of real investment skill.
Okay, wow. That's a really comprehensive overview of his core investment ideas. But you mentioned earlier these could apply beyond just stocks and bonds.
Absolutely. Think about second-level thinking in your career. First level, this job pays more. Second level, okay, but what's the culture like? What are the long-term growth prospects? What happens if the industry changes?
Considering the downstream consequences.
Exactly. Or risk as not achieving your goals. That applies everywhere. Choosing a partner, making health decisions. What are the real risks? The things that could permanently derail your life goals.
And price versus value.
Think about buying a house. The price is obvious, but the value includes the neighborhood, the commute, the lifestyle fit, the long-term maintenance costs. Is the price justified by the total value you receive? Or even learning a skill, the price is time and effort. The value is future opportunity.
Patient opportunism could be waiting for the right time to make a big life change. not just jumping at the first chance.
Perfect example. Contrarianism is questioning conventional wisdom in any field. Knowing what you don't know is crucial for any expert to avoid arrogance.
And psychology definitely applies outside markets, understanding biases in group dynamics or personal relationships.
Totally. Margin of safety. That could be having an emergency fund, backup plans for important projects, even just building downtime into your schedule so you're not always operating at 100%.
Having that buffer in life, skepticism helps you evaluate news, online claims, anything, really.
Right. And leverage isn't just financial debt. It could be overcommitting your time and energy. Avoiding permanent loss could mean steering clear of choices with irreversible negative health or relationship consequences. And disciplined analysis. That's just making any big life decision thoughtfully.
It really is a framework for rational decision-making in general. So, looking at Marx's reasoning overall, what stands out as particularly uncommon or insightful?
Well, his relentless focus on risk control first is quite distinct. Many focus purely on returns. He's always asking, how can I avoid losing? Also, his deep skepticism about prediction, focusing on preparation instead.
Prepare, don't predict.
Exactly. His nuanced view of risk beyond just volatility is key. And his rationale for contrarianism, based on understanding cycles and psychology, is very powerful. He accepts markets aren't perfectly efficient and finds opportunity there. It's this blend of hard-nosed analysis and psychological insight.
And the emphasis on buying well, the price paid.
Always comes back to that.
So let's distill some actionable takeaways that might clash with common investment advice.
Okay, first, high quality doesn't automatically mean safe. Price is critical. Forget buy quality at any price.
Right, second.
Prepare. Don't predict. Stop wasting energy trying to guess market direction. Focus on positioning for different outcomes.
Third.
Activities and achievement. More trading often means lower returns. Patience pays. Wait for the fat pitch. Think differently. The herd is often wrong, especially at extremes. Contrarianism, when well-reasoned, is valuable.
Fifth.
Risk is sneaky. It's often highest when it feels lowest, when everyone is complacent. Be vigilant, especially when things seem too good to be true.
And finally.
Process over outcome. Judge your decisions based on their quality and reasoning at the time, not just whether you got lucky in the short term. And Marx just has so many quotable lines that capture these ideas, like investment risk comes primarily from too high prices. He directly links risk to optimism and lack of skepticism, pushing prices up.
And the flip side, when everyone believes something is risky, their unwillingness to buy usually reduces the price to the point where it's not risky. That's the contrarian opportunity right there.
Exactly. And the warning. When everyone believes something embodies no risk, they usually bid it up to the point where it's enormously risky. Complacency is dangerous.
You mentioned this one earlier, but it bears repeating. High-quality assets can be risky, and low-quality assets can be safe. It's just a matter of the price paid for them. That really challenges assumptions.
It does. And his simple formula for contrarian success. Success, buy amid pessimism. Sell amid optimism. Easier said than done, but that's the goal.
And finding opportunity in turmoil. The greatest opportunities come when others are paralyzed by fear.
A word of warning about frothy markets. The 7 scariest words for a thoughtful investor are too much money chasing too few deals. Watch out for those times.
And finally, the bedrock principle. The most dependable way to outperform the market is to buy something for less than its value. Back to basics.
Couldn't say it better. It all flows from that.
So putting this book, The Most Important Thing, into context, where does it fit in the investing world?
Well, it's definitely in the lineage of value investing. Think Benjamin Graham, security analysis, the intelligent investor. That's its intellectual home.
And Warren Buffett is a big fan, right?
Right. Huge fan. He's famously said he opens Mark's memos immediately when they arrive. That's high praise.
How does it compare to other approaches, like quantitative investing or growth strategies?
It's different because Marx puts such a heavy emphasis on risk control and, crucially, market psychology. It's not just numbers. It's understanding behavior within that value framework. Some approaches are purely quantitative. Others chase growth, almost regardless of price. Marx offers a more balanced, risk-aware value perspective.
And it seems more accessible than some of the really academic texts.
Oh, definitely. That's a big part of its appeal. He explains complex ideas very clearly. People often comment on how readable it is compared to, say, Graham's original works, which can be dense. It bridges the gap.
He also wrote Mastering the Market Cycle. How does this book relate to that?
The most important thing lays out all the core philosophical principles. Second-level thinking, price value, risk, contrarianism. Mastering the market cycle takes one of those core idea cycles and dives incredibly deep into just that topic. So this book is really the foundation.
Okay, this has been incredibly thorough, a really deep dive into Howard Marks and the most important thing. We've hit on second level thinking, understanding risk properly, the price value connection, market cycles, patient opportunism. So many valuable ideas.
Yeah, it's a rich framework. And hopefully, listeners see how these principles aren't just for Wall Street. They're tools for clearer thinking and better decision making in, well, pretty much any complex situation life throws at you.
So, maybe a final thought for everyone listening. Think about a decision you made recently, big or small. Did you use first level thinking or did you push to that second level?
Yeah. What risks did you really consider beyond the obvious surface ones? Just spending a moment reflecting on your own process using some of Marx's ideas. That could be, well, the most important thing for making better choices going forward.
A great place to leave it. We definitely encourage listeners to check out Howard Marks' memos online. They're fantastic, and his books. Thanks for joining us on this deep dive.